this really caught my attention when I saw you on Twitter, and I was like, you know what? Like, I think more people need to know about this because so far, like, it seems like the options are really limited on what people can actually do. Like, you either got to take possession of it yourself, or you got to buy paper on the stock market and hope for the best. So, can you tell us a little bit about Idaho Armor Vaults briefly?
Sure, sure, and I appreciate you having me on. Yeah, basically, Idaho Armored Vaults was sort of a um, company that I created back in 2008. Just to give you a little bit more background, I started in the business, the financial business, in 1992. I was a registered investment advisor back then. I came on with Dean Witter, then Morgan Stanley back in the 90s. Went independent, started my own firm in 2001, started a hedge fund in 2001. By 2006, everything was leveraging up. You had the real estate market going crazy. And I was like, this thing is going to, you got to have assets outside the system because I was looking
Yep.
at systemic risk and counterparty risk that was just bleeding everywhere. And so I opened my own depository in 2008 after looking at all the industry and what was out there, and none of it fit my risk profiles. And so basically, I started Idaho Armored Vaults in 2008. It's the only depository that's not owned by a gold dealer, financial institution, or a cash in transit company like a Brinks, that type of thing. So it's really centered around the customer, and it's not driven by transactional revenue. So I don't need to be buying and selling metals to pay the bills of the vault. So I wanted to reduce enormous amounts of risks out there. And transactional revenue tends to be it gets impacted when you have big volatility in the markets, whether up or down, because sometimes, like in 2018 and 19, the business dried up and nobody was buying and selling. And then, of course, after COVID, you had a lot of activity.
Mm-hmm.
But when you're running a depository, you're really trying to protect people's assets, not necessarily enrich yourself at the same time. And so in 2009, I made relationships with wholesalers. We started buying, selling metals for not only the fund, because I basically moved the fund into a physical gold and silver fund. So about 99.4% of the fund is in physical metals now. All
Okay.
is held outside the financial system. Our depository isn't tied to the financial system per se, so it allows that buffer. We Most of our client base is typically higher net worth, but we work with clients in all capacities. We deal with IRAs as well, self-directed IRAs. So if the client wants to buy 500 ounces of silver, we can help with that as well. And we do drop
Beautiful.
shipping as well.
As
So
it can get
so
heavy. And so it's
yeah,
like keeping it at home, fills up a vault. That thing, it gets heavy for sure.
definitely. Yeah,
So I see that.
and the big thing is, our vault, we a 17,500 square foot facility. We run forklifts inside the vaults. I mean, that's how big we are.
Mm-hmm.
So we can move a lot of metal. We have insurance policies, $700 million all risk policy through Lloyd's of London. We can move up. We also have an armored car division that we can move up to 10 million in the vehicle, or the vehicles that we transport with. We also have domestic and international shipping through couriers, so we can insure through that as well, up to $500,000 per shipment. And also we have freight coverage. So if we're moving, a pallet to a silver via freight, we can insure that as well. So what we're trying to do is we have a lot of redundancy in our business. It's not just simply relying on one shipper or
Yeah.
one method of shipping. And on top of all that, we're the only depository in the world that is also an FFL. So we're a federal firearms license dealer as well.
Oh, that's
And
awesome.
that's Yeah, that part of that has to do with the gear that we use. We've actually now created a site that we actually sell a lot of the gear that we actually use, the level 4 plates and the thermal and the night vision and all that type of stuff. So we get into a lot of that stuff as well.
What's that website,
Uh,
in case anybody's wondering?
yeah, that's actually let's see, let's pull it up here. Um,
'Cause I have goldsilvervault.com open right now as well, just
yeah,
in case anybody else is wondering what your
yeah,
company.
this is going to be this is tier1tactical.org. So it's tier
Awesome.
and then the number one and then tactical.org. Yeah, just
Fabulous. I'll just pull it up right
the
now.
number instead of spelled out, yeah, just number one. Yeah, I think that's
Excellent.
yep, that's it. Yep,
Excellent. Man, you're
yeah,
all
and
over. You're all over. I love this right now. You got silver and gold, actual physical storage, physical delivery, and you guys sell firearms. You got me hooked already, my man. I gotta say, Bob.
yeah, we the gear we use is not the stuff you buy from Dick's Sporting Goods.
Yeah,
So,
it doesn't look
but
like it.
yeah,
Yeah, this is
no,
awesome. You
no,
build your own kits.
yeah. And on top of all that, we're a family-run business. Everybody who works for me is my children, which they're in their 20s and 30s. So it's not. I feel kind of old, but it's wonderful to have a family-run business where you control. Because if you look at the depository risk out there, 85 to 90% of the thefts or losses, I should say, are
Hmm.
inside related jobs.
Yeah,
So
it's
that was
funny.
one of the things I wanted to kill right off the bat. Um, and so we've never had a loss at the facility. It's just one of those things that, again, you're looking at risk management. It's all about. I totally get. If you don't hold it, you don't own it. I totally respect that. But sometimes when someone's buying, 2 tons of silver, they're not going to stick it in their closet and watch the floorboards break.
That's
They
true.
need something that's professional. So if they want to sell it, it's just a phone call. They're picking up the phone instead of 2 tons of metal.
Yeah.
So it's easier to make that transition, especially if you're doing swaps and you're moving from gold to silver or silver to gold. We can organize the logistics of that entire trade as well.
Excellent. What do your spot prices look like in comparison to, say, I go to some random dealer on the internet? Like, what are we looking at there? Is it about the same?
Totally. Yeah. We use the wholesaler spot prices, so it's not this artificially marked up 1%
Really?
above spot price that you see on a lot of online dealers, which is something I've been very vocal about the last 4 years. It's ever since 2020 when you had the COMEX, the exchange for physical premium blow up on the COMEX right after COVID hit.
Yeah.
And then you went to the $76 premium on gold versus the London market. A lot of the dealers started to price everything in COMEX terms, which I think was disingenuous. And it just allowed them to make even more money on top of the exaggerated premiums that a lot of them were charging as well. So I've been very, very vocal about that practice and just telling people, if you go to the pricing page, we have all our premiums right up on the website there. So it's just under. You just go under pricing. Yeah, just click on that, and then services. Yep, and then pricing, and that'll have the premiums over spot price. So you
Okay.
can kind of
Cool.
see, and that's basically for new metal.
Hmm.
If we get backdated stuff, we may be able to get a little bit better price for clients. So it's very competitive. The way I look at it is I look at the metals as an investment advisor, not a dealer. So I don't want to. My job is not to mark this stuff up and make a living off the customer. My job is to try to allow the customer the ability to make money in this product, in this, you know, I see the value of the metals, but the problem is the last 4 years, most people were giving away their purchasing power to the dealer in these huge markups and basically taking money out of their own pocket, um, which is very frustrating to watch because in this business the metals are volatile enough and it's very frustrating at times to watch this stuff and sometimes it's not going up, sometimes it goes down, and then you're trying to understand why is it making these moves, and then you're trying to overcome the premium on top of that, and now you're seeing is the markets are so there's so much inventory out there that the bids on a lot of these products are now at sharp discounts to spot, which is something that most people were not thinking of. And I was on a Twitter space that I did back in November of 2022 that was warning people you're going to start, if the prices go up, you're going to start seeing these premiums start dropping like a rock
Yeah.
and potentially going to discounts because you have a lot of overhead supply. A lot of people bought not just in the last 4 years, but there was more metal bought actually in 2010, 11, 12, 13 than there was today or the last 4 years on an annual basis. So you've got a lot of overhead supply people, being holding this stuff for 15, 20 years. Their lifestyle changes over that time frame. They move from, hey, capital appreciation and protection of capital to I need income. I'm
Yeah.
retired now.
Time to cash it out,
So
right?
yeah, so you see a lot of, and now with interest rates, T-bills over 5%, you started to see that shift unfold back in June of last year, where the industry was making the shift, and I was out there trying to tell people, hey, listen, the metals are slowing down. People aren't buying as much. You're starting to see people starting to sell into the market. There was more competition for metals because we went away from this zero interest rate policy
Hmm.
back in 2020, 21, and then early 2022 to the Fed start lifting rates. Now that created that competition, because a lot of people that bought metals back in 2021, 2020 was like, hey, listen, this is maybe a money market alternative because everything's basically zero bound in terms of interest rates. I might as well go into something that I can hold on to and not have the counterparty risk. And that trade I completely understood. But now you're seeing sort of that unwind of that. So
What are you thinking right now with all of the increases in central banks, especially what you're seeing with like China, Asia, and such buying up like vast amounts of gold and silver, and the shift from west to east in that sense?
yeah, definitely. That's been especially last year, that was a huge supportive factor in the gold market as the Western retailer and the Western investor was, after the big run you had from 2020 to early 2023 with the bank blow up in March, you
Hmm.
started to see, okay, um, profit taking, or you started to see, asset allocation shifts and moves into other asset classes. The stock market kind of bottomed and started moving up, and so you started seeing people that may have gotten out of the stock market after 2020 going into metals, reversing that trade. But yeah, the central banks have been kind of pivotal with this sort of recurring theme or support in the market of, they see the need for collateral, or they see that need to maybe diversify away from the dollar, potentially, as either maybe their own currency is going to have to inflate, so they got to strengthen their own balance sheet from a counterparty risk perspective, or or from a trade flow or swap line perspective, where they can uh, uh, maybe their currency, or the currencies that they're holding, they see potential inflation, structural inflation
Yeah.
coming down the pike, which they've been right on. I mean, especially and really they've been, central banks have been really net buyers of gold and sort of net sellers of U.S. Treasuries really over the last 10 years. I
Yeah.
mean, you've seen this shift sort of take place, and that's something that I think a lot of high net worth people started to see back in 2019, because you've had this, even though the retail got really popular in 2020 through 23, the large investor has always been in the market, sort of seeing the bigger picture of, hey, listen, I need to maybe allocate 10% of my assets into metals. And if you're dealing with a large portfolio and they're trying to dollar cost average in, or you just have an average investor that's saying, hey, listen, I want a dollar cost average over time. That's been really what's been sort of consistent in this marketplace. Even the last, as things have slowed down the last 6 months in terms of activity, and you started seeing sellbacks into the marketplace, the large investor has still been a stalwart in terms of continued buying.
Absolutely. Without them, I don't think that the the price of the metals would do well at all. So it's kind of like a catch 22, right? We need the large central banks to continue buying, which obviously they're going to, for everything from pharmaceuticals to war and everything in between is needs these metals, and it's a fantastic hedge. So what are your thoughts on actual silver and gold as a hedge against inflation currently, compared to staying in cash or the market, for example, and the volatility we're
Yeah,
currently seeing?
I've been a huge advocate for the physical metal. I'm not as big of a fan, being in the business as long as I have for 30 years. Mining stocks tend to be more of a trade, I guess you could say. If you pick the timing right, you can certainly do very well in that market. But it's from a longer term perspective, mining stocks are sort of it's a structural depletion of
Hmm.
resources that they're pulling out of the ground, and so you and what's really hurt the mining stocks is the inflation or their cost of production has gone up faster than the underlying asset they're pulling out of the ground, and that's been a very big frustration the last 15 years. I kind of learned a lot from like David Morgan, for example. I started listening to him back in 2003, talking about metals as a core portion of your portfolio. And I had a chance to talk to Jim Rogers back in the mid 2000s, 2005, 6 timeframe. And he actually had a good point. He said, the average stock does just as well as the underlying commodity that those companies are producing. And
Hmm.
so you can reduce a lot of the managerial risk and market risk, capitalization risk, and that type of thing, just by going into the commodity itself. And so learning through various bubbles in the market, sometimes keeping it simple is actually better. And so in the fund that I manage, it's 99.4% invested in physical metal. Of that, just for full disclosure, about 73% it roughly is silver, 27% is gold. So I'm very, very pro silver.
My
And
man.
some of the reasoning,
Why?
yeah, the reasoning, yeah, sorry. Yeah, the reasoning behind that is, you look at the gold silver ratio, it blew out to 125 to 1.
Hmm.
And I was, and I kind of posted this on Twitter back in March. I was selling gold and buying silver, rotating even heavier into silver, when we were 89.7 to 1 on the ratio.
Right.
But I try to be as educational and transparent as possible to maybe help people. It's tough enough to get caught up in the emotion and the volatility of the markets, but what I try to do is not really throw uh, the speculation and sort of the emotional side of the market into the social media. I try to explain things out, maybe try to get to things that maybe people don't understand why something's happening, or what makes this move, or how does this impact the market. I try to explain that away,
Hmm.
and then also at the same time talk about actionable information that someone can use to say, listen, I got, metals or money wrapped up in this program, and I went with it because it's convenient, or I went with it because the guy I listened to on YouTube, I kind of created some trust with just watching him,
Hmm.
but they don't understand the program at all. So I try to filter that as well to try and maybe help people kind of know what to look for when they're either looking for a program or already into a program, what the risks and rewards are.
Absolutely. I think that's great to hear. You were mentioning like the gold and silver ratio. If I recall, it's like around like 62 or 63 right now. Does that sound about right?
About 76, I think.
76. So it's gone up over like the last month then if I'm
No, it's been coming down hard.
okay.
It was about 90 to 1 back in March,
Yeah.
and then it's been coming down ever since. So yeah, I
Okay.
think it got to
Cool.
72, 73 to 1 about a week or two ago, and then it kind of, when silver was around 32 and a half or so, 32 and change, and then it picked up a little bit. Yeah.
Awesome. Okay. Yeah. Thanks for correcting me on that. Definitely want to give out good information. Yeah, but some people may not know what that really means. It's basically the number of ounces of actual silver that it takes to equal an ounce of gold. It expresses the difference in the price in the relationship between the two metals. So naturally, when it's higher, right? Like previously, it was over like the highest it's been like 120 or so, 120ish to 1. That indicates that gold is, I wouldn't say overvalued, but that silver is significantly undervalued. Do you think that'd be a fair assessment?
Yeah, I think, yeah, you're right on it, because naturally in the ground it's about 8 or 10 to 1.
Oh
So
wow.
about 10 ounces of silver for every 1 ounce of gold. And if you go back 500 years, it was typically about 12 to 15 to 1 in terms of monetary relationships. So whether it's France or Britain or wherever it may have been in power at the time, that was the relationship that the gold and silver had. It was really since the Fed was created, um, that you saw this sort of 15-to-1 relationship kind of fracture, and it may have been due to fiat currencies, but I think it also had to do with cost of mining and cost of production as well, because the cost of producing gold has gone up faster, I think, than the cost of producing silver. But now silver has been kind of playing catch up, and you're talking beginning of this year, for example, it was about $22-23 an ounce to create an ounce of silver from the primary silver producers. So what that meant was 75% of the mining of silver is actually done with byproducts of other mining or production facilities like copper, gold, zinc, lead, that type of thing, and silver is just a small byproduct that they kind of get when they mine copper out of the ground. So, but now, and if you look at the primary silver producers, and you look at their cost of production, the floor on silver tends to be where that cost of production is. And so the question now you have is, with silver breaking out, is inflation actually going to rise and impact the cost of production further, or will we see, you've seen sort of a production cap, or I guess you could say, where back in 2016 you had peak silver production and it hasn't surpassed that since. So you've been seeing this decline in silver production. Well, sometimes prices, if they start rising enough, it'll start to make it more economical to start going back into primary silver producing. So that's something to watch for. But of course, to get a mine off the ground, it doesn't happen overnight. So
it's a lot of work from what I've seen. I've previously had the chief executive officer of Highcroft Mining Corporation here on the channel as well. And they're about to start this year here, I believe this quarter. They're beginning to extract their silver and gold from the ground after several years of studies and all sorts of work that it takes to actually to begin before extraction can even begin. So when that starts to happen, I think people get really excited for the mining companies themselves, which is always good to see. But as far as what we have with Idaho vaults here, so people can buy actual precious metals and have it delivered to their house. Is that what you were saying as well? Like,
yeah, we
follow.
can drop ship. Yeah, we can drop ship, as well as we have clients that just buy from us and then they just basically have it delivered here to the facility. We take pictures of the products. We send them the report and pictures. We're one of the only depositories from day one that's always taken pictures of everything that's come in and send that to the client. So, because everything we do is on a segregated basis, which means nothing's commingled with other clients. It's your box is completely separate. You get the same exact metal that you originally had purchased. Yeah, I really built the business as if I was the customer, which is not something you see anymore.
Absolutely.
It's always like, hey, listen, how can I enrich myself and build a business that's going to benefit me? And who cares what what happens to the client? So really, I have sort of this sort of a fiduciary type of role that I kind of look at myself as when it comes to trying to protect the client's best interests.
I think that's fantastic. And we're kind of working on something similar as well from a stock and crypto brokerage standpoint. We're working on creating a stock and crypto brokerage, obviously. And I would love the opportunity to somehow partner with you guys in the future. We've never had this discussion before. I probably shouldn't be bringing this up on a live stream, but to be honest with you, man to man, I don't care.
Sure.
So we could talk about that in private, hopefully sometime soon. But yeah, just so people know, we've got no prior affiliation. We had, up until a few minutes ago, we had never met before. We had no prior discussion other than I saw your posts about silver and gold on Twitter or X, whatever you want to call it. And honestly, I'm like, this guy knows his stuff. Like, I have to have Bob on the channel. So I've been kind of like chasing you for a little bit here to have you come on, and I really appreciate you sharing your knowledge with everybody. So did you mention physical delivery as well? Because I know a lot of people right now that are doing very well in the stock market and that have some high potential for making a serious amount of money. If they didn't want to have, 500 pounds or, 10,000 ounces of silver or, whatever, a large amount of gold shipped to their house where then they have to worry about keeping it safe or, thieves or fires or anything like that. Did you say people could have it stored at Idaho as well and then later take physical
Yep.
delivery?
Yep, we can ship it to them, or if they wanted just to sell it, like if silver went up in price and they said, this is now overvalued relative to other assets, and I want to diversify now out of the metals, we can help with that transaction, wire the funds right back to the client, or send a check to them. Yeah, it's a really relatively pretty easy process. Typically, we can wire funds as fast as 15 minutes to the client. I mean, I've really catered to building customer service. It's what I've done for 30 years. I've never had a client complaint on my record as an investment advisor. Yeah, you just treat people right. You give them as much information as possible to make that sound decision. I tell people I am the worst salesman in the world. I can talk people out of the metals. Yeah, it's just, I try to do what's right. Sometimes you put on the investment advisor cap a little bit, and you get these clients that or people that call in, they listen to this guy on the internet, says the banks are going to blow up in 2 weeks, I got to get all my money out, and I'm like, let me just tell you a little bit about the banking system, and say, listen, you don't want to sell everything and buy the metals, because those are volatile, and if you do need liquidity, you don't want to take a 10% haircut just for the standpoint of listening to some guy trying to sell a newsletter, or try to sell overpriced metals. And so I see a lot of that out there, when it comes to just getting sort of explaining the understanding of how markets work, the futures markets, in terms of a lot of clients, or a lot of people say, well, God, Bob is like, he's pro bank, and I'm like, well, no, I just know how the industry works, so I can explain it a little bit better, and try to give some sort of background to how futures work relative to the spot market in the physical world. And there's relationships that you watch for to get guidance on direction, on position sizing, all that types of things.
You know what? Speaking of that, I'm glad you brought it up, because I have on my screen right now, I don't know if you can see it or not, but I pulled up the latest quarterly derivatives report from, sorry, what is it? It's not SIBO.
The OCC. That's the Office of Controller
Thank
Currency.
you. From the Office of the Comptroller of the Currency, OCC.gov. And this is something we've been tracking for a significant period of time here on this channel, as I'm sure you have, just like all business owners, especially in your field with what you do as an investment advisor in precious metals. But I want you to give me your take. I'm not going to tell you what I think, but I want your take on what you believe is the reason for this ridiculously large increase on the actual number of derivatives, the amount of derivatives, the notional amounts of precious metals contracts by maturity increasing from 2022, which was at a high of maybe $75 billion in 2021, and then 2022 shooting up to around 375 billion, and then what we're seeing in 2023 being nearly $500 billion in these contracts
Sure.
alone. Why do you think this is happening? What is your thoughts on the reason the banks are taking on such a large number of contracts in derivatives against the metals?
Yep. I wrote an article on this, actually. That big jump that you're referring to, was a lot of it was actually moving gold from the currency section of that report into the precious metal section, because prior to 2022, gold was actually in the foreign currency section. So what you're seeing prior to that big jump was just simply silver, platinum, and palladium, and then you saw that big kick in 2022.
Mm-hmm.
That was just simply the resizing, or I'm sorry, the reclassifying of gold into that. So that's what made it difficult to try and decipher out how much metal was actually, or how much derivative exposure was actually growing in the white metals relative to gold, because gold just took on such a bigger player. But when you saw that big jump from Q1 of 2022 to 2023, is that what
Zoom in down here.
Yeah,
Basically Q1 of 23 was a huge jump, and then the entire year of 2022 was pretty high as well.
Yeah, so if you look at, just let me know if you need me to explain some things, but in 2020 you had an increasing activity in white metals as and gold was difficult because gold was wrapped into foreign currency, so you couldn't really pull gold out and extract that data specifically for gold, but you could do it for the white metals. What you started to see in 2020 was a lot of derivative action, a lot of structured product vehicles being created on Wall Street, that started because what you're looking at with derivatives is, if to maybe explain it, if you ever watched the movie The Big Short, where
It's our
Michael
favorite
Berry
movie
goes
around
in,
here, my man.
yeah, where they went to Goldman Sachs and they said, "I need you to write me a contract or a deal for shorting the housing market." Well, that's a structured derivative product, and so what you're having in these contracts is that these are structured notes, they're structured vehicles where institutions saying, listen, I want exposure to silver, I just don't want to own the actual silver. So you have various different vehicles like buffered notes, for example. Let's say you want to protect against some downside activity because the metals are volatile. So maybe the first 20% move of the market, you're not going to get impacted, but at the same time, you're only going to get maybe 80% of the upside, if that makes sense. So you have, they use options, they use futures, they use other types of vehicles to kind of balance out that structure depending on what that institution's wanting. So when 2020 happened, you had this explosion in structured product vehicles, whether it be Bank of America, JP Morgan, and they started using like SLV as an index or an underlying index, or GDX, and so then they had vehicles that would compare SLV to the S&P 500, and you'd get the whatever is better returning, you get a rate of return off that, or whichever is worse performing. I mean, there's so many different ways you could bet into this market and structure a product for that, and so that's partly why you're seeing that huge impact or increase in derivative activity. It was a lot of structured products that were being created from that. And then, we look at, $1 billion of notional value. Well, a lot of that's leveraged stuff. So it may only be 10%, or 5% that are actually putting down
the actual
to
value.
create that vehicle. Yeah. And then a lot of this stuff is netted as well, or it's hedged in certain ways. And so some of this stuff gets a little bit lopsided. A lot of newsletter writers will say, my God, they're $80 billion in derivatives. That means they're short silver on Bank of America, short $80 billion. And I see that a lot, and it's not very truthful of what's happened, because Bank of America is a broker dealer or financial institution that also has customers. So they don't break out their customer portfolios to their proprietary trading desk, to their market making activities, and to their investment management side of their ledger. So they just report one number per se. So it makes it more difficult to kind of pull this information out and say, okay, who's really in trouble here as the market rallies.
It's very shrouded in dark, right? It's in the dark. It's shrouded in the dark. The amount of precious metals trades that occur in dark pools is continuously rising, and that makes things even harder. And like you were saying, a lot of people don't understand the operation of netting, right? And for those people, I want to explain that briefly. What Bob was saying is these banks use something called bilateral netting to basically use one contract to cancel out another, which can be dangerous on a large scale, absolutely. When there's so much, volatility out there. But the whole idea behind that is to basically hedge each, go long on one side, hedge that against going short on the other side. And I would put it kind of similar to a market maker when they're marrying a call versus a long call, when they're marrying it with someone that's selling a covered call. And that kind of allows the contract to cover that particular downside. The downside protection kind of covers the upside gains, and vice versa for people in the metals. And I definitely think it's a big problem, but it's really good to see. It's a big problem when there's problems in the market. Otherwise, when everything's going smoothly, everything's fine, right? And everybody appears to be just fine. And then you have situations where things kind of get out of control, and then there's serious problems. But what do you think would happen to these banks if this upward movement in silver and gold continued, and we saw silver get towards, $40 an ounce or even $50 an ounce. Because I'm seeing some reports out there and some people thinking that, and I'm almost starting to believe it myself, that silver at $50 an ounce would kind of mean like partial collapse of the US dollar, or even more accelerated than what we're currently seeing. So what are your thoughts on that, since you have even way more expertise on the field than I do?
Yeah, it gets interesting because it's hard to compare silver with like GameStop, for example, or
Oh
the
yeah, of course.
AMC situation. So there you have a supposedly fixed number of shares outstanding, and you can only
Yep.
short so much, and then you get into that squeeze scenario, and then all of a sudden, if you're naked short, you're screwed, basically. Well, in silver or in the futures market or in commodities in general, you can create futures contracts out of thin air.
Mm-hmm.
People, most 95%, 96% of the contracts traded, those people never want to deal with the physical. They're just trading on margin. They're using that leverage to try and get to position themselves either for a short-term trade or a long-term trade or a day trade, whatever it may be. Where it gets interesting is where you get into the ETFs a little bit, because the ETFs are a little bit different than the futures markets, in that the authorized participants, they can actually, as market makers themselves, they can naked short as part of the reg show
Mm-hmm.
ruling or regulation. That they can make that market and go short into a rising market, with the expectation is, if they have metal, for example, that they can get in London, they can then deliver the metal to the ETF, create shares, and then use those shares against their short book if they wanted to. There's different methodologies that these market makers and authorized participants can use to sort of manage the market. Maybe I hate to use the word manipulate, because
No, go ahead.
manipulate implies something illegal, and
Yeah.
you have to prove it in a court of law, whereas managed or something of that nature is, hey, listen, this is part of business practices, and everyone does it, or we're allowed to do it because that's what the regs say we can do.
Right.
So what I was doing with silver, really from February and in March, I was seeing some very interesting things unfolding in the silver market, where you saw short positions and short activity, short sales volume started to really increase in the SLV ETF as well as the GLD ETF. And it got to a point where all of a sudden, volume was rising, silver was breaking out through 26, the short volume was continually picking up, and I was like, this doesn't make any sense, because who would want to be short where you had this 3 or 4 year channel, inverted head and shoulders, you had and you had the makeup of a breakout here. Why would anyone want to be short in front of that thing? And then at the same time, you saw ETF flows doing something really weird, which is people weren't buying the ETF. I mean, SLV was breaking, or silver was breaking out, and everyone could care less.
Yeah.
I was like, this doesn't make any sense. Either nobody cares about the metals anymore. That's one of the reasons why I kind of talked about this mother of all short squeezes back in February. Was the idea that back in February and early March, managed money was actually shorting the piss out of the futures market
Yep.
on the silver, and they were sort of this idea that, hey, listen, the Fed is not going to raise or not going to lower as much. May go into a recession. Silver is an industrial metal; it's going to get caught up in maybe less demand and that type of thing. So they were basically playing the Fed's playbook. But in reality, what was happening under the surface was you had demand rising in India, in China. You had an increase in production of solar panels that were growing. The U.S. government was making efforts to promote solar usage and activity. So that was adding to the demand for silver. So you had everything was kind of picking up almost like a wave that was developing in the ocean. It was like a perfect perfect storm almost that was happening with silver, catching people that were positioned on paper, for example, or investors that were just worn out over the last 3 or 4 years, saying, "My God, everything's going up. Bitcoin's going to 70,000. The metals haven't done absolutely anything. This is the worst investment in the world." I mean, I saw the despair in February was just. I was like, "My God, this is like." The sentiment of all sentiment indicators that you want to look for when you're trying to be a contrarian.
Yeah.
You had the bullish percentile index and the gold miners, at levels which were typical bottoms before. In the silver symposium that I spoke with in October of last year, even I was saying what you're going to see is the market's going to start rising and no one's going to believe it. They're going to sell into it. And as every time this ratchets it up, people are going to continue to sell into it, expecting that the banks are going to smash it right back down. That's one of the reasons I hate about the industry is they promoted this idea that the markets are so manipulated that the banks will never allow the markets to rise, gold and silver markets to rise. So
Bingo.
Most retail clients have been embedded in this idea that this market will never go anywhere, and people have been selling into this market, and you haven't had this retail FOMO develop. It's been a very odd environment. Everyone who's been in the metals for the last 15, 20 years, we're ballooning the deficits, the debt levels, the economy is slowing down, but then it's being force fed with more fiscal spending, more deficit spending, moving maturities from long duration to literally 6 months.
Yep.
You have the election coming up. They're going to obviously manage the markets in front of that election to give them the best sort of perspective, or I guess people vote with their wallets, so to speak. No one's going to riot with their 401k at the top of the market.
So Bob is telling us exactly what we know that is going to happen. Exactly.
Sorry.
No, continue.
Yeah.
I mean that in a good way.
Yeah.
Well,
I mean, these are just 30 years, over 30 years in the business of, hey, listen, this is what's happening. It's inflate or die. That's basically the choice that they have. They can't let this debt start to roll over and become a deflationary type of wave, because that could happen. It's certainly it's possible. I mean, you've had major drops in the market before that's wiped out a lot of people, and that certainly is a very strong possibility. I think they're doing everything they can to stave off a recession, because the moment they start seeing unemployment rise and a true recession taking hold, you're going to have that hit the wealth effect. You're going to have people starting to pull back on spending. You're going to have collateralization, those assets that are collateralizing the loans, whether it be housing, credit cards, or just personal assets, whatever it may be, or stocks in general. Everyone's borrowed to the gills, so to speak. You start to see that unwind.
Yep.
That has tertiary effects that you're going to kill tax revenue. You're going to kill municipality tax revenue with a lower in property values. Pensions are going to be severely underfunded, because a lot of these guys are in they moved into private equity.
Yep.
Some of the most illiquid and we're talking rolling the dice type of investments out there. I mean, there's a lot that's going on, and I think people are starting the high net worth individuals the last 4 years have said, listen, the metals in times of crisis or in times of uncertainty, hard assets is where people tend to gravitate to in the history of mankind. I mean, it's a natural, I trust what I hold in my hand, not necessarily what someone else is holding for me. And that's what you've been seeing. That's what's been driving this market really the last 4 or 5 years.
And a lot of people were doing that exact same thing. I think, well, you remember when the last time silver was at $17 an ounce?
2022.
Exactly.
Well, I think it was like 18, something like that. Yeah.
It was about 2022, because we were stocking up on silver, but before that it was around 2018. Yeah. And then again, since then in 2022, we were stacking up silver at $17 an ounce. And people at the time were saying, why are you buying that shit? Why don't you buy crypto? Why don't you buy the S&P? Well, the S&P is not up 80% since then. Some cryptos can be, but not most of them. Most of them are not. And you also, if we have an issue with markets in general, I would say that this is a much better way to hold on to my cash than in the digital market. So, yeah, a lot of people have felt the same way. You know, they're like, should I buy silver at 17? Should I buy it at 21? Should I buy it at 23? Should I buy it at 25? And now here we are over $30. We were at 32, almost 33 a couple weeks ago. Even, do you think the $30 is obviously this is not financial advice, but do you believe that $30 is the new support level for silver?
I think what you're seeing is it's trying to define a new range. I mean,
Yeah,
you broke through
I think you're right.
26. If you look at, I did a chart, sort of a thread on Twitter or X back in August of last year, and I've been kind of tickling and publishing it every month or two. Basically, I compared 2008 to 2011's chart to 2022 timeframe, the 2020 to 2022-23 timeframe, and the charts are literally identical. You had the big drop in 2008 with the financial crisis. You had this in 2022 after you had this big run up. You had this sharp drop from 28 down to 17 or so. You know, everyone got frustrated. This is the worst investment in the world. And then it's been building this sort of inverted head and shoulders, this sort of higher lows scenario that it's been basically building over the last, really the last 3 years. You know, you've had that 2022 head, and then you just been building this right shoulder, and it just took off. And that base that you're seeing, that 4-year base and that inverted head and shoulders, that's a very powerful base that you can call it a high level consolidation, whatever technical term you want to use, but you got to be respectful of it, because if you look at 2008 to 2010, it did the exact same thing. After the break in 2008, it bounced up, it started leveling out, making higher lows, building that base, and by late 2010, early 2011, when it broke through 28, it only took 3 or 4 months and it was at 50. And that's just how silver moves. Silver,
yeah, you're absolutely right.
Yeah, and I kind of showed this at this is one of the presentations I did at the Silver Symposium. You know, I try to keep it simple. I try to use information of not going down this rabbit hole of sort of, I don't say conspiracy, but stuff that's like, you're just trying to say, my God, where is this ever going to end? Some people will dissect the delivery reports on the futures markets, which don't mean anything, because the delivery reports are simply just warrants trading hands. It's not actual physical metal. So
right.
These stops and that type of thing, it means nothing. For a guy like me that watches it, it's like just noise. And so I'll watch the stock reports where metal's actually moving in and out of the registered category, that type of thing. But I'll also watch London's LBMA numbers. I watch the exchange for physical premium, which is simply a spread trade between the London physical market and the lead month futures contract. And so you're watching for shifts and patterns where maybe that price or that spread trade, which normally declines as it gets closer and closer to expiration, kind of like an option, it starts to make outside moves. Maybe it accelerates one way or the other. It goes, maybe either more in contango, where the futures become more expensive relative to the spot market or physical market, or backwardation, which is what we saw in 2022, where the physical market became dominant and was actually well bid, and you were seeing a lot of buying, especially out of India.
Mm-hmm.
And I was talking about this at nauseum in really July, August of 2022. We saw something we'd never seen before, which was you had a backwardation in all 4 precious metals at the same time. I mean, that's how much the futures markets were selling off relative to the demand to the spot market, saying, hey, listen, sell it off, give me more. I'm going to continue to buy. And so the spot market became more expensive than the lead month futures contract. But those are things that I try to point out to give people sort of confidence, why to buy, or if they've already bought, why you want to hold. These are times where it's forming a low, and just identifying that helps people's psyche of holding onto an asset.
Yeah, I think a lot of people misunderstand the difference between trading for the sake of making a quick profit or protecting yourself from the dangers out there in the world, the macroeconomic and the geopolitical issues that lead to massive inflation and the value of holding actual precious metals uh, in your hand or in a vault somewhere you can access it is a lot greater than holding the paper on the markets. So I definitely have to agree with you on that, Bob, and I think that was a great point. But you're absolutely right. I just pulled it up, and what we saw in the charts in 2008 was it broke through $28 level in November, and 6 months later it was at $48.35. So that's absolutely true. And of course, history doesn't always repeat, but it often rhymes. And
Yep.
we saw here in 2020, it was as low as $10.86. Shot up not too long after that, to over $20 or so, whatever that was, $22. Came down, had a nice retracement again in 2022. It was back down to 17, and it looks like it's ready to push through, and it is pushing over. And that's exactly what we're seeing. We're seeing a really nice support here over the last several months on it to get it over 30. And I do have to agree with you in the sense that it does seem to want to be making a new range, over the $30 level. So I really appreciate you, Bob. I don't want to make this video too long because I don't want people's attention spans to get, fatigued, if you will. So can you tell us anything else briefly about Idaho Armored Vaults at, goldsilvervault.com that you might want people to know? By all means, the floor is yours, my friend.
Sure. No, I appreciate it. Yeah, we've again been in business since 2008. We have 700, almost 700 million in assets that we store. It's most of it. We also do collectibles, fine art, that type of thing. But it's just something that we have clients from all over the world that store with us. We don't require a tax ID number. Assets are held outside the financial system. I mean, we do follow industry practices of knowing your client and anti-money laundering type of rules, that type of thing. But it's really what we've kind of been known for is really the customer service. If a client is really truly worried about the financial system and says, listen, I want my own little ATM machine, basically. I want the ability to buy and sell, take delivery, go pick it up, if I have to drive to it. That's really where we've kind of made our bread and butter. We're not
Cool.
we're not this structured program that says, hey, listen, we have control of your metal, and then if you want to buy or sell, you have to go through us. Even at the depository side, the client has the control. They can sell back to us, or they can sell to another dealer and we can ship to them. I mean, that's what you call true customer service. It forces me as I call myself a purchaser representative, not a dealer, but I can do all the things dealers can do. But it forces me to say, listen, I have to be competitive and I have to be looking out for your best interest. It's not simply, hey, you're storing the metals with me and I'm going to drop the bid to $2 under spot and you have no other choice but to sell through me. I don't like that. I don't like the client having it is. And I've seen it all over the industry. It's very frustrating to watch this where the consumer has just, the last 4 years they had their pockets picked trying to buy metals as a way to protect purchasing power. In reality, what they were doing is giving up their purchasing power by paying these exorbitant premiums. And now clients that are frustrated or selling into this rally saying, hey, I bought it at 20, I want to sell it and make money. If a dealer's offering $2 under spot, they're still not making $30 an ounce. Mm-hmm. And that's frustrating to watch because I want the investor, the consumer, to have a good experience in this industry, because that's what makes the metals. I think that's what will broaden our platform, I guess, as an industry and as an asset class. You're not going to garner a lot of participation if we're going to be looked at as like used car salesmen. You buy the car and you have no clue what you're going to get when you take it off the lot.
Yeah, there's a big difference between precious metals and used cars, though. I'll give you that. You're definitely not selling the same garbage that they're selling garbage. Yeah. Precious metals, though, you can't even compare. But I totally understand what you mean as far as the sentiment. You don't want people to feel like you're a used car salesman or anything like that, or trying to, take one over on them like some of the other dealers. Like, for example, if I went to whatever, some random dealer right now online, if I Googled one and I tried to sell my silver, yeah, you're absolutely right. They would try to give me, $2 plus less than the actual spot price right now. But if I wanted to buy from them, they'd charge me $2 more. So
Yeah.
you definitely make a great point in that sense, and nobody likes getting ripped off. So I'm all for other options and people learning everything they can about ways to protect themselves and to store their money for the future and to help grow that money. So I want to say thanks again, Bob. Again, make sure you guys check them out on Twitter at Profits Plus ID. It's up on the screen right now. You can check out their website, which I had up there again a moment ago. If you guys, goldsilvervault.com, as well as they have a tactical shop in which they sell tactical gear, because you guys definitely protect your own, right? So that's tier1tactical.org, also on the screen right now. So I want to say thanks again to Bob. Appreciate you, my friend, and hopefully you can join us again on the channel, because I've had a blast. And honestly, I could talk to you for another several hours, but I don't think everyone else could listen to us go for much longer. So I really
Sure.
appreciate you, sir.
My pleasure. Thank you for having me on.
Cheers, my friend.